Before we begin today's analysis, I want to extend a brief invitation. If you value thoughtful, disciplined approaches to financial markets, the kind of insights that cut through noise and focus on substance, I encourage you to subscribe to this channel. We're building a community of serious investors who prioritize rational strategy over reactive speculation. Your presence here matters. Now, let's discuss something urgent that's unfolding this week. A disruption is occurring in Mexico that carries implications far beyond its borders. This week, civil unrest in key Mexican regions has begun to paralyze silver shipments from one of the world's most critical production centers. Transportation routes are blocked. Mining operations face operational constraints. Supply chains that feed global markets are experiencing measurable friction. This is not speculation. This is happening now. Why does this matter to you? Because Mexico produces nearly 1/4 of the world's silver supply. When that supply encounters obstacles, even temporary ones, it sends ripples through commodity markets, industrial supply chains, and investment portfolios. But here's what separates disciplined investors from reactive ones: understanding the difference between a headline and a structural shift, between a temporary disruption and a fundamental change in market dynamics. Today, we're going to examine this situation with clear eyes and steady hands. Let's establish the facts as they stand. Reports this week indicate that protests and civil disturbances in several Mexican states, particularly in regions with concentrated mining activity, have led to road blockades and operational slowdowns. The specific catalysts for these disturbances vary by region, but the effect is consistent: interrupted movement of goods. Silver mining doesn't stop the moment roads are blocked, but shipping does. Processing schedules get disrupted. Supply commitments to refiners and industrial buyers face delays. Is this the first time something like this has happened? No. Mexico has experienced periodic disruptions before, from labor disputes to security concerns to natural disasters. Each time, markets react. Each time, cooler heads eventually prevail. But frequency doesn't diminish relevance. Each disruption provides us with information about supply resilience, market reflexes, and investor behavior patterns. The immediate question isn't whether silver will disappear from global markets. It won't. The question is, how do supply constraints, even temporary ones, interact with existing market conditions? And what does rational positioning look like when uncertainty enters a commodity system? Context requires proportion. Mexico's dominance in silver production is substantial, but not absolute. As of recent data, Mexico produces approximately 23 or 25% of global mined silver. That's significant. But it also means roughly 75% of global supply originates elsewhere. Peru, China, Chile, and Australia are major producers. Each contributes meaningfully to global supply. A disruption in Mexico tightens supply, but it doesn't eliminate it. However, supply chains operate on assumptions of continuity. Industrial users, manufacturers of electronics, solar panels, medical devices, automotive components, depend on predictable flows. They maintain inventory buffers, yes, but these buffers aren't infinite. When a major supplier encounters friction, the immediate market response often outpaces the actual supply deficit. This is where investor psychology enters the equation. Markets don't just react to physical shortages. They react to the fear of physical shortages. They react to headlines. They react to uncertainty itself. Understanding this distinction is crucial because it informs how we think about price movements in the days and weeks ahead. Silver occupies a unique position in commodity markets. It functions simultaneously as an industrial metal and a monetary metal. Roughly half of silver demand comes from industrial applications, electronics, solar energy, medical uses. The other half comes from investment demand and jewelry. This dual nature creates interesting dynamics during supply disruptions. When industrial users worry about supply, they may accelerate purchases to secure inventory. When investment buyers sense supply constraints, they may increase positions expecting price appreciation. These behaviors can reinforce each other, creating price momentum that exceeds the fundamental supply gap. But commodity cycles teach us something important. Momentum cuts both ways. Prices that spike on supply fears can retreat just as quickly when supply normalizes. Markets that overshoot on scarcity concerns often correct when reality proves less severe than feared. This isn't a prediction. This is pattern recognition based on decades of commodity market behavior. Understanding these patterns doesn't tell us what will happen tomorrow. It tells us what kinds of scenarios carry historical precedent. Let's look backward to see forward. In 2020, when pandemic-related disruptions affected mining operations globally, silver experienced significant volatility. Prices moved sharply as supply concerns combined with monetary stimulus expectations. But within months, mining operations adapted. Supply chains adjusted. Prices stabilized before eventually finding new equilibrium levels. In 2011, silver experienced a dramatic spike, reaching near $50 per ounce, driven by investment demand during post-financial crisis monetary expansion. But that peak couldn't hold. Within months, prices corrected sharply. Many investors who bought at euphoric highs suffered significant losses. The lesson isn't that prices can't rise. They can. They do. The lesson is that extreme moves, especially those driven by fear or euphoria rather than sustained fundamental shifts, tend to mean revert. Now, consider Mexico's history specifically. The country has experienced numerous periods of social unrest, labor disputes, and security challenges over the past 2 decades. Some affected mining operations temporarily. Each time, operations eventually resumed. Supply flows eventually normalized. Does this guarantee the same outcome now? Of course not. But it provides probabilistic context. It reminds us that temporary disruptions, historically, have been temporary. Here's what typically happens when commodity supply stories break. First, prices react. Sometimes modestly, sometimes dramatically, depending on existing market sentiment and positioning. Early movers, those already watching the commodity closely, respond quickly. Then, broader awareness spreads. Media coverage amplifies. More participants enter the market. FOMO, fear of missing out, begins influencing decisions. This is where discipline becomes most valuable and most difficult. Because in these moments, 2 competing narratives emerge. One says, this is the beginning of a major supply crisis. Act now or miss the opportunity. The other says, this is temporary noise. Stay calm and assess rationally. Which narrative proves correct? It depends on factors we cannot fully predict in real time. The duration of the disruption, the response from other suppliers, the actual magnitude of the supply deficit, the broader macroeconomic context. But here's what we can control, our response to uncertainty. Disciplined investors don't make large, concentrated bets based on breaking news. They assess their existing exposure. They consider scenarios. They adjust gradually if adjustment is warranted. They avoid emotional decisions driven by fear of missing out or fear of loss. This approach won't maximize gains if prices spike dramatically and hold, but it minimizes the catastrophic losses that come from mistiming volatile moves. This Mexico situation doesn't exist in isolation. Global macroeconomic conditions create the backdrop against which commodity disruptions play out. Right now, we're navigating a complex environment. Interest rate policies from major central banks remain historically significant. The strength of the US dollar influences commodity prices denominated in dollars, including silver. Global industrial production trends affect industrial demand for silver. Simultaneously, longer-term trends continue developing. Solar energy expansion drives industrial silver demand. Electronics proliferation does the same. These aren't crisis-driven factors. These are structural forces that unfold over years and decades. A supply disruption in Mexico matters more or less depending on where we sit in these broader cycles. If global industrial demand is accelerating while supply tightens, the impact magnifies. If industrial demand is soft, while supply disruptions prove temporary, the impact moderates. Right now, we're in a period of mixed signals. Some industrial sectors show strength, others show weakness. Monetary policy remains in transition. Currency markets reflect uncertainty. This context doesn't give us clear predictions, but it reminds us why single variable analysis, focusing solely on Mexican supply, is insufficient. Markets are systems. Multiple variables interact simultaneously. Let's think about equilibrium. Silver markets, like all commodity markets, seek balance between supply and demand. When that balance tips, prices adjust to restore equilibrium. If Mexican supply drops by, say, 10% for a month, that represents roughly 2 to 2.5% of global monthly supply. Meaningful, yes. Catastrophic? No. Other suppliers can increase output marginally. Industrial users can draw down inventories temporarily. Some discretionary investment demand can defer purchases. Prices may rise enough to bring these adjustments into play. But here's the critical point. The market adjustment mechanism works faster than most people expect. This is especially true in commodities with relatively liquid markets and multiple production sources. The scenarios where prices remain elevated long-term require sustained supply deficits, not temporary disruptions. They require demand continuing at elevated levels while supply cannot respond. They require structural changes, not momentary friction. Could the Mexico situation evolve into something more sustained? Potentially. Civil unrest can persist. Political situations can deteriorate. But betting investment capital on worst-case scenarios, without evidence those scenarios are unfolding, is speculation, not strategy. If you currently hold silver, whether physical metal, mining stocks, or ETFs, you're facing a decision point. Should you add to positions on the assumption this disruption creates opportunity? Should you reduce positions to lock in any price gains? Should you hold steady? Let's think through this systematically. First, assess your current allocation. If silver already represents an appropriate portion of your portfolio based on your risk tolerance and investment timeline, there's no urgency to change anything. Temporary supply news doesn't fundamentally alter your long-term thesis unless it represents a structural shift. Second, consider your entry points. If you purchased silver at significantly lower prices and now see meaningful gains, taking some profit isn't missing out, it's risk management. Locking in partial gains while maintaining core exposure is often wise during volatile periods. Third, resist the urge to dramatically increase concentration based on breaking news. Adding to positions because prices might spike is speculation. Adding to positions because fundamental analysis supports higher long-term valuations, and you have capital available within your risk framework, is strategy. What about timing? Should you act immediately? Here's the reality. If disruptions prove more severe and sustained than currently visible, you'll have opportunities to add exposure over weeks and months, not just days. If disruptions prove temporary and prices retreat, patience will have served you well. The disciplined approach is to monitor developments without reactivity. Watch for actual production data, not just headlines. Watch for how industrial buyers respond. Watch for whether other suppliers increase output. Make decisions based on evolving evidence, not fear of missing short-term moves. If you don't currently hold silver and you're wondering whether this Mexico situation creates an entry opportunity, let's establish a framework. First question, why do you want silver exposure? If your answer is because prices might spike due to Mexico, that's a weak foundation. You're chasing news, not building strategy. Short-term price speculation based on supply disruptions is difficult even for professional traders. For long-term investors, it's usually a losing game. If your answer is because silver fits my portfolio, diversification needs and current prices seem reasonable relative to long-term fundamentals, that's a stronger foundation. In this case, the Mexico situation is just one data point among many. Second question, what's your timeline? If you're thinking days or weeks, you're speculating on crisis momentum. That requires timing both entry and exit precisely. Most people fail at this. The costs, both transaction costs and emotional costs, often exceed any gains. If you're thinking years or decades, short-term supply disruptions matter much less. You're focused on whether silver has a role in long-term portfolio construction, whether industrial demand trends support sustained usage, whether monetary concerns justify some commodity exposure. Third question, how much exposure makes sense? This isn't a question about silver specifically. It's a question about your overall asset allocation framework. Most disciplined investors limit commodity exposure to a modest percentage of total portfolio, typically single digits. This provides diversification benefits without creating concentrated risk. If you decide silver merits inclusion, the Mexico situation might offer a reasonable entry point, or it might not. The key is entering with appropriate position sizing, clear reasoning, and no expectation of quick profits. Silver mining stocks present a different risk-return profile than physical silver. These companies are leveraged plays on silver prices. When silver prices rise, mining profitability can increase dramatically because production costs are relatively fixed. But the reverse is also true. When prices fall, profitability compresses quickly. Additionally, mining stocks carry operational risks, management risks, geopolitical risks, and company-specific risks that don't apply to physical metal. The Mexico situation adds another layer. If you're considering Mexican silver mining companies specifically, you're taking direct exposure to the source of disruption. Some investors might see this as buying the epicenter of a crisis. Others might see it as concentrating risk unnecessarily. Mining stocks in other jurisdictions, Peru, Canada, Australia, might benefit from Mexican disruptions without direct exposure to the source of problems, but they also carry their own operational contexts. The point is this: mining stocks shouldn't be confused with silver itself. They're equity investments in businesses that happen to produce silver. All the considerations that apply to stock investing apply here: fundamentals, valuation, management quality, balance sheet strength. If you don't regularly analyze individual stocks, treating mining equities as a simple way to access silver exposure often proves problematic. Consider silver ETFs or physical holdings instead. Let's be explicit about what not to do. Mistake number 1, making large, concentrated bets based on breaking news without understanding your complete risk exposure. When crisis headlines hit, the temptation is to act decisively. But decisive action without proper context is often reckless action. Before increasing any position significantly, understand how it affects your total portfolio. Understand your liquidity needs. Understand whether you're emotionally prepared for that position to move against you. Mistake number 2, using leverage or margin to amplify exposure to a volatile commodity during a supply crisis. Leverage magnifies gains, but also magnifies losses. In volatile markets, even correct directional bets can stop out due to intraday swings before ultimately moving in your favor. Leverage also forces timeline compression. You need to be right quickly, not just eventually. For most investors, leverage during crisis periods is a path to losses. Mistake number 3, assuming short-term price momentum predicts medium-term direction. Just because silver rises 5% this week doesn't mean it rises another 5% next week. Momentum can exhaust quickly, especially when driven by supply fear rather than sustained demand growth. Extrapolating recent moves into future expectations is a common error that leads to poorly timed entries. Mistake number 4, ignoring exit strategy before entering positions. If you buy silver, in any form, because of Mexico supply concerns, what's your exit plan? At what point do you take profits? At what point do you cut losses? Under what conditions do you reassess? Entering without exit criteria means emotions will determine your exit, usually poorly. Mistake number 5, confusing volatility with opportunity. Yes, volatile markets create potential for gains. They also create potential for losses. Volatility itself isn't profitable. Correctly positioned volatility can be profitable, but that requires skill, timing, and often luck. Most investors generate better long-term returns by avoiding volatility, not seeking it. Mistake number 6, overtrading based on daily news updates. Every day will bring new headlines about the Mexico situation. Some will sound alarming, some will sound reassuring. If you trade based on these daily updates, you'll generate transaction costs and emotional exhaustion while likely underperforming simple hold strategies. Mistake number 7, neglecting broader portfolio context. Silver might be moving dramatically, but what's happening with your stocks, your bonds, your real estate exposure? Making decisions about one asset class without considering total portfolio impact leads to unbalanced risk exposure. Let's consider an alternative view. What if the market overreaction to Mexican disruptions creates opportunity in the opposite direction? If silver prices spike sharply on supply fears, but actual supply deficits prove modest and temporary, prices may retreat quickly. Investors who bought high on fear could create selling pressure. This pattern, crisis-driven spike followed by normalization, has played out repeatedly across commodities. Some investors position for mean reversion rather than momentum continuation. They wait for panic buying to exhaust itself, then enter at more favorable levels. Or they use volatility spikes to reduce exposure they wanted to trim anyway. This isn't a recommendation. It's an acknowledgement that markets contain multiple valid perspectives. Bull and bear cases coexist. The challenge is determining which scenario carries higher probability given available evidence. The contrarian view asks, if everyone suddenly wants silver because of Mexico news, has the opportunity already been priced in? Has the easy money already been made? Are we late to a trade that early movers already captured? These questions don't have certain answers, but asking them promotes clearer thinking than simply following momentum. Step back from the immediate crisis. What drives silver value over years, not weeks? Industrial demand trends matter enormously. Solar panel manufacturing consumes significant silver. Each solar panel requires silver paste for its electrical components. As global solar installation accelerates, driven by energy transition policies and cost improvements, silver demand from this sector grows. Electronics manufacturing represents another major demand source. Smartphones, computers, automotive electronics, medical devices all use silver for its superior electrical conductivity. As global technology adoption continues, this demand persists. Investment demand responds to monetary conditions and inflation expectations. When investors fear currency debasement or seek portfolio diversification away from financial assets, precious metals, including silver, attract capital. Supply responses also matter. If silver prices rise sustainably, mining companies invest in new production capacity. This takes years to develop, but eventually adds supply. Recycling also responds to higher prices. More silver gets recovered from electronics waste when economics justify it. The Mexico situation is noise against these fundamental factors. It might accelerate or delay price movements, but it doesn't change whether solar installations will continue growing. It doesn't change whether electronics demand will persist. Long-term investors focus on these fundamental trends. Short-term traders focus on supply disruptions. Both can be rational depending on strategy and capability, but confusing the two creates problems. Whatever your position, existing holder, new investor, or skeptical observer, risk management remains paramount. Position sizing is your first defense. No single commodity should dominate your portfolio. If silver represents 2.85% of assets, a 50% loss in that position is a 1 to 2.5% total portfolio loss. Painful, but survivable. If silver represents 30% of assets, a 50% loss is catastrophic. Diversification across asset classes reduces single-point failure risk. Commodities, stocks, bonds, real estate, each responds differently to economic conditions. No one knows which will perform best in coming years. Diversification acknowledges uncertainty. Time horizon clarity prevents emotional decisions. If you bought silver for 10-year reasons, 1-month price movements don't matter. If you bought silver for 1-month speculation, every day matters. Matching position duration to actual timeline prevents premature exits and entries. Liquidity awareness ensures you don't need to sell during unfavorable conditions. If you might need capital in the next year, don't tie it up in volatile commodities. Reserve volatile investments for truly long-term capital. Emotional discipline might be most important. Markets will move against your position sometimes. Prices will fluctuate dramatically during crisis periods. Your ability to maintain strategy despite discomfort determines long-term success more than perfect timing. Mexico's situation doesn't exist in isolation from global political and economic forces. Latin American countries face complex challenges: economic development pressures, social inequality concerns, resource nationalism debates, security issues related to organized crime, political transitions, and policy uncertainties. These factors affect not just silver, but all commodities produced in the region. Copper, gold, lithium, agricultural products all face similar risk profiles. Investors in commodity-producing regions must acknowledge this context. Diversification across geographies mitigates concentration risk. Understanding political economy helps assess whether disruptions are isolated incidents or symptoms of broader instability. Should Mexico's current unrest prove part of a sustained deterioration in operating conditions, mining companies would need to reassess operations. Some might reduce investment. Some might shift focus to other jurisdictions. This would have supply implications over years, not days. But reading too much into short-term events is also risky. Countries and regions cycle through stable and unstable periods. Projecting current difficulties indefinitely forward often proves incorrect. The balanced view acknowledges risks without assuming worst cases. It monitors developments. It adjusts expectations gradually as evidence accumulates. How does a silver supply disruption compare to disruptions in other commodities? In 2021, a severe winter storm disrupted Texas oil and gas production. Prices spiked. But within weeks, production normalized and prices retreated. The short-term crisis didn't create lasting supply constraints. In 2020, pandemic-related shutdowns affected copper production in Chile and Peru. Prices initially fell on demand concerns, then rose on supply concerns. Eventually, both supply and demand adjusted, and prices found new equilibrium levels. Rare earth supply chains face ongoing concerns about Chinese production dominance. This creates persistent premium pricing due to geopolitical risk, not just physical supply constraints. The market prices in the risk of disruption, even when actual supply flows normally. The common thread: markets distinguish between temporary disruptions and structural supply changes. Temporary disruptions create volatility. Structural changes create sustained price adjustments. For Mexico and silver, the question is which category the situation falls into. Current evidence suggests temporary disruption. If evidence shifts towards structural problems, sustained unrest, permanent operational challenges, long-term transportation constraints, market response would intensify. Until evidence of structural problems emerges, treating this as a temporary disruption seems more appropriate than assuming permanent supply reduction. Be aware of how media coverage influences market behavior. Financial media needs compelling content. Supply disruption stories provide that. Headlines emphasizing crisis, paralysis, and breaking situations attract attention. This isn't criticism, it's recognition of how media economics work. But attention-grabbing headlines don't necessarily translate into proportionate investment implications. A headline reading "Mexico unrest paralyzes silver shipments" sounds dramatic. The underlying reality might be more modest: some roads blocked, some delays, some operational challenges. Savvy investors distinguish between headline drama and actual magnitude. They seek primary sources. They look for production data, not just reports about disruptions. They assess whether market price movements already reflect the news or if information remains unpriced. During crisis periods, media coverage also creates feedback loops. News drives price movement. Price movement generates more news. More news attracts more participants. More participants drive more price movement. This cycle can continue until exhaustion, when no new buyers remain or when actual supply conditions prove less dire than feared. Understanding these dynamics doesn't tell you what to do, but it helps you recognize when you're operating in an emotionally charged information environment. That recognition alone promotes clearer decision-making. How should the Mexico situation inform portfolio construction decisions? If you're building a diversified portfolio from scratch, does this change your commodity allocation? Probably not substantially. The Mexico situation is a data point, not a paradigm shift. If you've been considering commodity exposure generally, silver might deserve attention alongside gold, energy, agricultural commodities, and industrial metals. But weighting silver heavily based solely on Mexican supply concerns would be reactive positioning, not strategic allocation. If you're reviewing an existing portfolio, ask whether your commodity exposure reflects your risk tolerance and market views. If you have no commodity exposure and believe inflation risks or supply chain vulnerabilities warrant some allocation, adding modest silver exposure could be reasonable. But making that decision specifically because of this week's news is probably poor timing. Portfolio construction should flow from strategy, not news. News-informed strategy, yes, but individual events shouldn't determine overall structure. The disciplined approach is to develop allocation frameworks based on long-term views, then make modest adjustments as conditions evolve. Large reallocations in response to short-term events usually prove costly. History offers valuable lessons if we're willing to examine it. In the 1970s, oil supply shocks created severe economic disruption. Prices rose dramatically, but eventually, high prices incentivized new supply, reduced demand, and efficiency improvements. Markets adjusted, though it took years. In 2008, food commodity prices spiked due to supply constraints and speculation. The food crisis generated alarming headlines, but prices peaked and retreated as agricultural supply responded and speculative positions unwound. In 2011, rare earth prices exploded on fears about Chinese supply restrictions. New mining projects launched globally in response. Within a few years, prices collapsed as supply caught up to demand. The pattern: crisis drives prices up sharply. High prices incentivize supply response and demand reduction. Eventually, balance restores at new equilibrium levels that may be higher than before the crisis, but lower than crisis peaks. For Mexico and silver, this historical pattern suggests a likely trajectory: short-term volatility, potentially elevated prices for some period, eventual normalization as operations resume and markets adjust. Does this guarantee that outcome? No, but it provides probabilistic guidance based on how commodity markets typically function. Let's address what might be the most challenging aspect: managing your own reactions. When markets move dramatically, adrenaline flows, the urge to act becomes powerful. Watching prices rise while sitting in cash creates fear of missing out. Watching prices fall while holding positions creates fear of further losses. These emotional responses are natural. They're also often counterproductive. The investors who succeed long-term aren't those who never feel emotion. They're those who recognize emotional states and pause before acting on them. They create space between impulse and action. Practical techniques help. Before making any trade during volatile periods, write down your reasoning. What specifically are you assuming? What evidence supports that assumption? What could prove you wrong? If you can't articulate clear answers, you're not ready to trade. Another technique: decide in advance how much you're willing to allocate to a volatile position. Make that decision during calm periods, not crisis moments. Then, if you choose to act during volatility, stay within predetermined limits. Also helpful, remember that missing a short-term move doesn't destroy long-term wealth. The opportunities to build wealth compound over decades. Any single trade, any single position, any single market move is a small part of that longer journey. This perspective doesn't eliminate fear or greed, but it contextualizes them. It reminds you that preservation of capital and consistency of approach matter more than capturing every price swing. Since we cannot predict exactly how Mexico's situation evolves, we should prepare for multiple possibilities. Scenario 1: disruptions prove brief, operations resume within days or weeks, supply normalizes quickly, prices retreat from any spike, market returns to pre-crisis levels. If this occurs, investors who acted aggressively based on supply fears may face losses. Those who maintained discipline and avoided overreaction will have preserved capital and avoided unnecessary volatility. Scenario 2: disruptions persist for several months. Supply remains constrained. Inventories draw down. Prices rise sustainably. Industrial users compete for available supply. Investment demand accelerates. If this occurs, those with existing silver exposure benefit. Those who added modest positions during early uncertainty capture gains. Those who remained entirely unexposed miss appreciation but avoid no lasting harm. Scenario 3: disruptions reveal deeper structural issues. Operating environment in Mexico deteriorates meaningfully. Production permanently declines. Supply deficit persists long term. Prices rise substantially and remain elevated. If this occurs, commodity exposure proves valuable. But even in this scenario, those who acted with discipline and appropriate position, sizing outperform those who overleveraged or concentrated portfolios excessively. Notice that, in all scenarios, disciplined approaches produce reasonable outcomes. Aggressive, concentrated bets produce either large gains or large losses, depending on which scenario unfolds. We cannot control which scenario occurs. We can control our positioning. Consider the situation from industrial users' viewpoint. Manufacturing companies that depend on silver inputs face potential cost increases and supply uncertainty. They might respond by accelerating purchases to secure inventory. They might seek alternative suppliers. They might explore material substitutions where technically feasible. These industrial responses affect market dynamics differently than investment demand. Industrial buyers have less price elasticity. They need the material for production, regardless of price within certain ranges. But they also think in contract terms and supply relationships, not daily spot prices. If industrial buyers panic and overorder to secure supply, they create artificial demand surge. When supply normalizes and their excess inventory becomes clear, they pull back. This creates a whipsaw pattern. Initial price spike followed by weakness as the demand pulse fades. Investment buyers, by contrast, can enter and exit quickly based on price expectations. Their demand is more price elastic. They're buying financial exposure, not production inputs. Understanding these different demand sources helps interpret price movements. A price rise driven primarily by industrial hoarding has different persistence than a price rise driven by sustained investment demand growth. We've covered substantial ground. Let's consolidate the strategic implications. If you currently hold silver at reasonable average costs and it represents appropriate portfolio allocation, the strongest move is often no move. Monitor developments without reactivity. Maintain your positions unless evidence suggests fundamental reassessment is warranted. If you hold silver at cost bases much lower than current prices, consider whether taking partial profits serves your overall risk management. You need not exit entirely, but reducing oversized positions during volatility is often wise. If you're considering new silver positions, ensure your reasoning extends beyond the Mexico situation. If long-term fundamentals support silver exposure and current prices seem reasonable relative to those fundamentals, modest allocation may be appropriate, but don't chase crisis momentum. If you're skeptical about commodities generally or silver specifically, nothing about this situation demands you change that view. Missing a rally in an asset you don't own and didn't want isn't a mistake. It's strategy consistency. For all investors, regardless of position, the Mexico situation serves as a reminder that supply chains carry risks. Diversification across geographies, asset classes, and commodities mitigates concentration risk. This isn't news, but it's worth reinforcing. We've examined a developing situation with seriousness and nuance it deserves. The Mexico unrest affecting silver shipments is real. The potential for market volatility is genuine. The uncertainty about duration and magnitude is unavoidable. But uncertainty doesn't require panic. It doesn't demand aggressive action. It doesn't justify abandoning discipline. What uncertainty requires is clear thinking, proportional response, strategy consistency, emotional awareness. You're not powerless in the face of market volatility. You control position sizing. You control risk exposure. You control whether to act or wait. You control whether to follow emotion or maintain discipline. The investors who build lasting wealth aren't those who perfectly time every market move. They're those who avoid catastrophic mistakes, who preserve capital during turmoil, who maintain strategy despite discomfort, who recognize that no single event, no matter how dramatic the headline, determines long-term outcomes. This Mexico situation will resolve, either quickly or gradually, either favorably for silver prices or not. But your financial future doesn't depend on guessing which scenario unfolds. It depends on how you position yourself to handle multiple possibilities. You've taken time to understand this situation deeply. You've considered historical context. You've examined multiple perspectives. That preparation isn't wasted regardless of what happens next. Because the skills you're developing, critical thinking, emotional discipline, strategic patience, apply to every market challenge you'll face across your investing lifetime. Market disruptions will continue occurring. Supply shocks, demand shifts, geopolitical events, monetary policy changes, each will generate headlines. Each will create volatility. Each will test your discipline. What matters isn't predicting each disruption. What matters is developing the frameworks, habits, and emotional resilience to navigate disruptions when they arrive. That's what separates temporary market participants from permanent wealth builders. Thank you for investing your time in this analysis. I encourage you to revisit the concepts we've discussed as events unfold. Compare your reactions to the principles we outlined. Notice when emotion pulls you toward reactivity and when discipline pulls you toward patience. This is how we grow as investors, not by avoiding challenges, but by facing them with clear eyes and steady hands. If you found this approach valuable, remember that subscription invitation from the beginning. We're building something meaningful here, a community of investors who prioritized substance over sensation. Until our next analysis, maintain your discipline, trust your process, and remember, lasting wealth comes not from capturing every move, but from avoiding costly mistakes. Stay focused, stay rational, stay prepared.